Welcome to the course Mastering Risk in Professional Trading. In this video, we will break down a comprehensive capital preservation strategy that separates amateurs from professionals. Learn how to protect your assets and trade systematically. Before we begin, please take a moment to review this risk disclosure. Trading involves significant risk and is not suitable for everyone. All information in this video is for educational purposes only and does not constitute financial advice. To trade like a pro, you must understand optimal risk-to-reward ratios. As shown here, a 1-to-1 ratio requires a 50% win rate just to break even. However, by shifting to a 1-to-3 ratio, you achieve asymmetric profitability, meaning you can stay profitable even with a lower percentage of winning trades. Now, let's establish our strategic foundations. To navigate volatile markets, we must define the core pillars of survival and growth. These principles will serve as your roadmap for making disciplined decisions under pressure. Let's dive into our capital preservation objectives. Our core objective is simple: preserve your ability to trade another day. Think of capital as your inventory. Without it, the business ceases to exist. By limiting losses, we unlock the compounding edge. Remember, significant drawdowns require exponential gains to recover, making the avoidance of the big loss your top statistical priority. To manage risk, we must first identify it. There are three primary types we face. First, market risk, stemming from unfavorable price movements. Second, liquidity risk, where a lack of buyers or sellers prevents you from exiting at a fair price. And third, execution risk, which includes slippage and technical failures during the entry or exit phases. Now, let's break down the most important tool in your trading arsenal, the position sizing formula. It starts with the numerator, your cash at risk. This is calculated by multiplying your risk percentage by your total equity. This figure represents the maximum dollar amount you are prepared to lose on this specific position. Next, we have the denominator, the price risk. This is the gap between your entry price and your stop loss, which defines the potential loss for every single share you buy. By dividing your total cash risk by the risk per share, you get the exact number of units to trade. This professional standard ensures your risk remains consistent regardless of market volatility. This formula is the definitive foundation of your professional trading career. It takes the abstract concept of risk and turns it into a precise, actionable number. By mathematically linking your total cash at risk to the technical distance of your stop loss, you create absolute consistency. Whether the market is calm or volatile, and whether you are trading expensive stocks or cheap ones, your risk remains identical every single time. Mastering this calculation is what removes emotion from your execution. It ensures that no single trade can ever break your account, giving you the mathematical certainty to stay in the game and grow your capital systematically. This isn't just a formula, it is your roadmap to long-term survival. Let's put this into practice with a real-world example. Imagine you have a $6,500 account and you want to risk 1% on a single trade. This means your maximum allowed loss is $65. You find a setup with an entry price of $25 and a stop loss at $24.50. The difference, your risk per share, is exactly 50 cents. By dividing your $65 total risk by the 50-cent risk per share, the formula tells you to buy exactly 130 shares. This way, you know your precise loss before you even enter the trade. To execute our strategy, we need effective mitigation tools. First, use hard stop losses to automatically exit positions at predefined levels. To protect your profits, implement trailing stops that move higher as the price increases. For advanced protection during uncertainty, consider hedging with correlated assets. Finally, always maintain diversification across uncorrelated sectors to prevent a single failure from damaging your entire portfolio. Now, let's look at the mathematical reality every trader must face: the cost of recovery. Notice the table on the left. A 10% loss is a minor setback, requiring only an 11% gain to recover. But as the losses grow, the math becomes your enemy. Look at the mathematical trap on the right. If you suffer a 50% drawdown, you don't just need 50% to get back. You must earn a staggering 100% profit just to return to break even. This asymmetry is why small losses are easy to manage, but big losses are traps that can end your career. Always remember, preserving your capital is your #1 priority. Everything we've discussed, the math and the position sizing, accounts for only 20% of your success. The remaining 80% is trading psychology. The challenge isn't just finding a setup, it's managing the human operator. Your brain is hardwired to fear loss and chase gains, leading to FOMO and the impulse to ignore your stop loss when the market moves against you. Professionalism begins with emotional resilience. This means shifting your mindset. Stop viewing a stopped-out trade as a personal failure. Instead, treat it as a necessary operating expense, the simple cost of doing business. If you can control your mind, you can control your capital. We've covered a lot today, from the hard math of position sizing to the internal battle of trading psychology. But if you take only one thing away from this lesson, let it be this. Success in the markets isn't about predicting the next big move. It's about surviving long enough to let the probabilities work in your favor. It's about strategic discipline and maintaining your quantitative edge. Remember, the best traders are the best risk managers. Master your risk, and the profits will take care of themselves. Thank you for watching, and I'll see you in the next lesson. Good luck, and stay disciplined.